Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and in today's video I have some very good news to share for REIT investors. President Trump just announced that the US and China have come to an agreement to materially reduce their tariff rates for the next 90 days to leave each other more time to negotiate a more comprehensive new trade agreement. I think that this is very good news for REITs, especially because it will greatly increase the odds of us seeing significant rate cuts later this year. Here you need to remember that REITs have been heavily discounted for the last 3 years because of the surge in interest rates. And therefore, if we now see significant rate cuts, I think that this will mark the beginning of a new REIT bull market, which could push their valuations a lot higher. Today, REIT valuations are at a decade low level, and therefore the upside potential could be very significant. But why do I think that this increases the odds of us seeing significant rate cuts? And it really boils down to two things: the economy and inflation. Firstly, on the economy, my opinion is that the trade war is greatly weakening the US economy. And it's not just my opinion. You can look at statistics, surveys, polls, company results even, and you'll see that business confidence as well as consumer confidence is taking a big hit. And it's not surprising because the uncertainty is just too high. And so companies are delaying major new investment projects, they are freezing new hirings, consumers are closing down their pocketbooks, they are spending less money. This is already reflected in the latest retail numbers, which were quite soft. And so it is weakening the economy. Normally in this type of situation, the Fed would step in, cut interest rates to stimulate the economy. But so far it hasn't been able to do so because of the fear that the high tariff rates could lead to a spike in inflation. It's as if this trade war tied down the hands of the Fed, because on one hand they want to stimulate the economy, but on the other hand they also want to make sure that prices remain stable. They don't want to see another spike in inflation, and yet these high tariff rates could cause that. And that's why I think that this new trade deal is such good news for rates, because it will greatly reduce the risk of us seeing a spike in inflation. The tariff rate on China has now been dropped from 145% to just 30%, which is not far from what it was prior to this latest trade war, prior to the Liberation Day, as President Trump called it. And so I think that this trade war de-escalation, especially with China, but also with other countries, is going to give the Fed more flexibility now to cut interest rates to stimulate this weakening economy. And the debt market seems to agree with me, as it's currently expecting 3 to 4 rate cuts by the summer of 2026. This would bring interest rates into the low to mid 3s, which would be very significant news for the REIT sector. I think it could push a lot of our favorite rates a lot higher, given how discounted they currently are. Just to give you a few quick examples that come to my mind, NNN REIT, ticker symbol NNN, is a blue chip style net lease REIT that's similar to Realty Income. It has a 35-year track record of steady dividend growth, a strong BBB+ investment grade rated balance sheet with very long debt maturity, so no major impact from the surge in interest rates. Its leases are very long, at about 10 years on average. They include annual rent escalators of about 2%. Its tenants are responsible for all property expenses, including even the maintenance. And so this is a very high quality REIT, strong management, strong balance sheet, great assets, highly consistent and predictable cash flow, and yet it's today trading at a historically low valuation, priced at just about 12 times FFO, offering a near 6% dividend yield. This is a type of REIT that I would expect to surge a lot higher if interest rates are cut by about 100 basis points over the next year. I would expect this type of REIT to reprice at closer to a 4% dividend yield, and that could result in 30 to 40% upside from here. If you're willing to take more risk, there are of course some smaller and lesser known REITs that are even more heavily discounted and could present even more significant upside potential. One that comes to my mind is Armada Hoffler Properties, ticker symbol AHH. The REIT is today offering a near 8% dividend yield with a conservative payout ratio in the low 70s. It owns a portfolio of mixed-use properties that typically combine a retail, residential and office component. They are in high barrier to entry markets. These type of mixed-use properties in walkable locations are very desirable. They're doing really well. There's significant synergies between the different uses, and that makes them quite unique and gives them a competitive advantage often in attracting and retaining tenants. Its rents are growing steadily today. The REIT is also retaining enough capital to keep reinvesting in new development projects, and yet it's trading at just around 7 or 8 times FFO, offering an 8% dividend yield that's well covered. side. Again, if interest rates are cut significantly, the REIT has quite a bit more leverage also than most REITs, and therefore it would benefit even more from these rate cuts. I think that we could see a REIT pricing at closer to 12 times FFO that will lead to more than 50% upside from here. But so the point of this video was to show you that President Trump's latest trade deal with China and the further de-escalation from this trade war could trigger a boom in the REIT sector, because it will increase the odds of our bull thesis playing out, and this bull thesis relies on us getting some rate cuts later this year or next year, because these rate cuts would immediately increase the value of the cash flow generated by REITs, and quite substantial in many cases, as I just showed you with NNN REIT and Armada Hoffler, but there are so many more REITs that could enjoy significant upside potential. At the same time, it also reduces the risk of the bear thesis playing out, and the bear thesis, the biggest risk for REIT investors this year was that these high tariffs would remain in place, result in high inflation, preventing the Fed from cutting interest rates, all while the economy weakens. That would have been a worst case scenario, and it seems that we are now increasingly likely to escape, and escape is not the right word, what's the word I'm looking for? To avoid this scenario from playing out. So overall, I'm growing increasingly bullish as a result of this latest announcement. I'm very happy to see this happen. I hope that we can further de-escalate from here, which would give flexibility for the Fed and other central banks around the world to keep cutting interest rates, which would be very beneficial for us as REIT investors. Before I end this video, can you please do me a huge favor and click the like button, subscribe to the channel. If you want to access my full REIT portfolio, you can also join High Yield Landlord, which is my REIT newsletter for 2-week free trial. It will be the first link in the description of this video. Thank you very much again for your support. See you at my next one. Bye bye.